Methods of mortgage payments. Different names are tied to mortgage and trust deeds to describe a certain feature of the loan, its purpose, type of interest, and security used. Fixed-rate mortgage. A fixed-rate mortgage is a loan that has an interest rate that doesn't change over the life of the loan, regardless of inflation or other economic indicators. The only changes in monthly payments would be the result of changes in property taxes and insurance. A two-step loan, also referred to as a balloon reset loan, has interest rates and payments that are fixed for only a specific term. Once the term ends, the borrower can either repay the loan or allow the interest rate to reset to the current interest rate, which will remain the same throughout the remaining life of the loan. The drawbacks of this loan are: the rate is usually higher than the initial variable rate being offered at the same time. If interest rates were to decrease during the term of the loan, the borrower would have to refinance the loan and incur new loan costs in order to take advantage of the lower rates. As a result, during periods of high interest rates, more borrowers will lean toward adjustable rate mortgages. Adjustable rate mortgage. An adjustable rate mortgage has lower interest rates than a fixed-rate mortgage. The initial rate and payment stays the same for a limited period. After that period, the ARM rate increases or decreases over the life of the loan, based on fluctuations and other economic indicators. The interest rate is based on the index rate and a margin amount that is fixed and subject to caps on changes in the rate or payment amount. Amortized loans. Amortization is the process of paying off a loan by gradually reducing the balance through a series of installment payments. There are two types of amortized loans: full amortized and partially amortized mortgages. A fully amortized mortgage provides for periodic payments that repay the loan in its entirety by the end of the mortgage term. The most common methods of payment used for these loans are the level payment and budget mortgages. A level payment mortgage provides for equal payments of principal and interest throughout the loan period. As the principal balance is paid down, the portion of each payment that applies to the principal increases, while the portion applying to interest goes down. Regardless, the total monthly payment remains the same. A budget mortgage provides for monthly mortgage payments to include an amount equal to 1/12 of the estimated annual property taxes and property insurance premiums, homeowners association dues, and/or special assessments. A partially amortized mortgage provides for some, but not total, amortization during the mortgage term. It has payments that are equal and regular in nature. The loan term, however, is shorter than the time needed to repay the full loan balance by making those payments. At the end of the loan term, a large balloon payment is needed to pay off the remaining balance. Negative amortization. If the payments being made on a loan aren't enough to cover all of the interest due, the unpaid interest will accumulate to the principal of a mortgage loan, causing the balance to increase instead of decrease. This usually occurs with graduated payment mortgages. Payments begin at a level that doesn't pay all interest. Payments gradually increase until it reaches amount that amortizes remainder of loan. ARM with payment caps. Borrower makes payments that don't cover interest while more interest is being added on. Payment option ARM gives borrower option to make payments to amortize loan over 15 or 30 years or to pay interest for a few periods. Minimum payment option doesn't cover interest being charged. Reverse mortgage has balance that increases as loan proceeds are dispersed to borrower while interest is added to balance. Interest-only loans. With an interest-only mortgage, no amortization is done for the term of the loan. The principal is repaid at the end of the loan term through a balloon payment. Some interest-only loans are combination loans. They offer an initial period where payments are interest-only, then future payments are much higher that amortize the loan for the remaining term. Construction loans. Construction financing is high-interest temporary financing. It is used to cover costs of labor and materials for construction. It extends from start to completion of a project when it is paid off. The proceeds are usually like permanent forms of financing. At the beginning, when there is no building, the land is used as collateral. Some lenders want construction loans to be the primary mortgage on the property. These loans are not provided if the land has existing liens. Construction loans are usually open-end mortgages or line of credit where the lender commits to around 75% of the property's value after work is finished. Initially, the lender doesn't release the full loan amount. Instead, advances are provided as work is completed. In order to receive the full release of funds, a building inspector has to release a certificate of completion.